Everyone has spent the last 2 years obsessing over GPU chips and LLM models. But right under our noses, the focus of the AI boom shifted. NVIDIA's Jensen Huang recently pointed out a critical reality. Memory and storage have become the massive bottlenecks in AI infrastructure. Now, Sandisk, ticker symbol SNDK. If you looked away for a second, you missed one of the most explosive semiconductor rallies in history. At the start of 2026, Sandisk was trading down around $237. Within months, it rocketed past $1,700, generating an absolute masterclass in momentum trading. But if you look at the markets right now, things are getting incredibly volatile. After leading a fierce semiconductor rally, a sector-wide correction slammed the stock down more than 30% from its all-time highs in a matter of weeks, pulling it back down towards the $1,350 range. So what is actually driving this wild ride? It boils down to a fundamental change in how data centers operate. Large language models don't just require massive processing power, they require instant access to petabytes of high-speed data. Traditional hard drives are too slow, meaning high-performance NAND flash memory is no longer a consumer luxury. It's critical infrastructure. Sandisk is riding a massive wave of enterprise SSD demand. But as any seasoned investor knows, memory has historically been a brutal, cyclical commodity market. Is this time truly different? Because the growth numbers are so unprecedented, Wall Street is experiencing a massive split on how to price this stock. The valuation divide on Sandisk is one of the wildest you will see on the market. On one extreme, you have bears holding an ultra low price target of $235, betting that the AI hype will cool and expose structural vulnerabilities in NAND pricing. On the other side, prominent ultra bull analysts just doubled their price targets to a towering $32.50 per share. Why such a massive gap? It's about sustainability. Optimists argue that tight global supply and new long-term data center supply agreements mean pricing power will stay strong. Look at the multiple discrepancy. Its trailing PE is elevated at around 47 times, but because earnings are projected to expand heavily, its forward PE drops all the way to a single-digit 7.45 times. If those multi-year supply deals hold, the stock looks incredibly cheap at its current levels. But if those data centers pause spending, that trailing multiple becomes a dangerous cliff.